to take us through his expectations from the banking sector this time around in terms of earnings. Pranav, morning. This is Rima here. First, top down. Can you give us the big picture on what we should expect from banks this time?
Good morning, Rima. So this time you should still see the continuation of good times with a very healthy year-on-year growth numbers, both from an EPS perspective as well as the income perspective. But on a Q-on-Q basis, I think the gains would be muted with limited increase in net interest margins and OPEX continuing to remain high. OPEX growth continuing to remain high for most of these banks.
All right. So you're saying that the loan growth is expected to be on the stronger side, right, Pranav? And if yes, what would top the charts in terms of private sector banks for you, for an investor?
Okay. On a year-on-year basis, it still remains high. You have the system growing at 15-odd%. So we expect, most of these banks to report numbers around that range. Now, within banks, the ones focused more on the consumer side would see a stronger growth. The likes of ICICI Axis, which have a greater tilt towards consumer loans, would see stronger growth. And so will the smaller banks, which are even more focused on the retail segments. So banks with more retail would see stronger growth. Whereas on the deposit side, the pressure would ease or would have eased last quarter with an increase in liquidity. On a Q-on-Q basis, the deposit growth was actually higher than the credit growth, which means that deposit also was not a big constraint for most of these banks.
So what are the numbers? Because if the real constraint for banks to grow was the fact that deposits were expected to slow down. You're saying on a quarter-on-quarter basis, deposits have actually picked up and it's higher than the credit growth. Can you give us the numbers and what does this mean then?
Okay, so the deposit growth has been more closer to about 3% quarter-on-quarter compared to about 2-odd% for credit growth, right? So what it means is that for the banks which were going to be constrained on CASA growth, the ones with higher yielding segments could have been constrained if the deposit growth had not returned. Now that still is not a constraint now, and therefore with the note ban and other factors driving up liquidity, you will see that across segments, you will see strong loan growth.
Which are the banks where we've seen a strong deposit mobilization? Who could benefit?
Two or three factors at play here, Rima. I think one is you have a shift away from CASA to term deposits. So that is an industry-wide shift which is happening. So across banks, you will see that CASA growth slows down and term deposit rates would be the ones driving the overall deposit growth. The smaller two, then you have banks which can afford term deposits, which is those lending at higher yields. The smaller private sector banks, for instance, would see strong deposit growth, whereas those which are focused more on corporate side and therefore cannot afford to fund it through TDs would probably see a slower growth. The second is you've also seen a bit of repricing on CASA deposits. So a lot of banks have started putting out higher interest rates for SA accounts. Those banks would also see a stronger growth in deposits.
Okay. You want to leave us with your views on how PSU banks are shaping up, not just the larger guys like SBI, but also the rest of the pack. And also in terms of valuations, do PSU banks offer a better opportunity even now compared to private?
Yeah, I think they definitely trade at a lot lower valuations than the private sector banks. And there is still some room for them to grow in terms of their loan growth or deposit growth before the structural constraints start to kick in. Now, remember that the public sector banks have benefited from having excess liquidity in the last 12 to 18 months. There is still some excess liquidity left for them to use that to keep delivering growth on par with the private sector banks. So you will continue to see stronger EPS growth as well as growth almost on par with the private sector banks. The big question is once that is done, which probably is 6 months away, then the deposit growth will become a constraint for these public sector banks. That is probably where you will start seeing them underperform the private sector banks when it comes to earnings growth, etc.
Pranav, one question on HDFC Bank in particular. When they came out with the Q1 update, the street was very disappointed to see the lending growth number. I think it was just about 13%. And consensus expectations was that, maybe the bank would continue to see growth of high teens that it used to deliver. And that's what's been priced in. How would you read HDFC Bank's lending growth rate number that they reported in Q1? And does it mean that the bank is too big to continue to grow at those rates?
Good question. So I think the way I read it is that the headline number, yes, looks at 13 for the combined entity. But when you break it down and look at the gross loan growth, including the IBPCs, then the loan growth looks a lot stronger, right? So the bank standalone loan growth was closer to 20%. And if you combine with HDFC Limited's retail growth, even then the number looks healthy at about 19%. I think there are a few factors at play here, which leads to lower headline number. One is there is a rundown of non-retail book of HDFC Limited. These are loans that the bank does not want to put into the bank format. And second, there is also a balance sheet optimization which is happening. They are using IBPCs to kind of trim down the loan growth and manage the balance sheet transition. So to us, it appears like a one-off because the gross loan growth, including IBPC, still look good. And the retail deposits also looks good in terms of the year-on-year growth. So at this stage, we would think this is a one-off and not a change to the structural story of market share gains.
Any banks which might disappoint, according to you, this time? Where the street is being a little too optimistic?
I think the disappointment will be more on the margins front. I think for some of the smaller banks, despite growth into what I would call higher yielding or riskier segments, the ROA uplift might not be enough. So the disappointment, if any, would be more on the margin front rather than on the growth front.
Right, we'll let you go on that note. Thanks a lot for joining in and explaining to us what could be the outcome of the quarterly performance from the banking sector.